Okay, well, welcome to this week's Lightboard. And we're going to be looking at two questions today. We're first going to look at partnerships. So you've been learning about partnerships income and being able to distribute that income to the partners. So the question I'm going to do is quite a simple one, but the concepts apply for the whole way through, depending if you had a simple question of income and deductions to whether you had a big list of income and deductions. Same principles apply. First off, we work out the net income of the partnership over there in the orange. Now, the net income is defined under Section 90 of the 1936 Act, which says it's assessable income minus allowable deductions. But there are some deductions we can't claim, which are things like superannuation for the partners, any wages paid to the partners, interest on capitals, interest on drawings of the capital, because that is all part of an advance payment via the partnership to them of the profits. You then take away any of the deductions, you get net income, and you must distribute the income. And even if we ended up with a loss, the loss must be distributed across to the partners as well. The second part of the question is to make sure that the net income you have there in orange is distributed to the partners. And of course, in this question, we have Leela and Bender. And I've drawn you up this summary sheet that you should be using in the blue in order to work out that you distribute exactly the same amount as A in B. Now, once you've worked out the distribution of the partnership net income or loss, that goes further down into working out the partner's individual taxable income. And we do the same. Their assessable income, less allowable deductions, tax on taxable income, rebates, Medicare, etc. So as I said, the first step is always start with what is the net income of the partnership. Now, we were told, and it is question 2 in the book, that they had sales. So their sales were $200,000. They had interest from the bank of $5,200. So they have in total $235,200 in assessable income. We then look at the allowable deductions. The expenses, operating costs, so these are the costs associated with operating the business, are deductible at $83,000. We have staff salaries. Now, this is the salaries you pay to your employees. So your employees' wages are always deductible. Any wages paid to Leela and Bender are not deductible. They are part of a distribution pattern. We also had staff superannuation. And staff super is also deductible, but super paid by the partnership for the partners is not. It forms part of C, working out their taxable income. Now, we were also told that we had Leela and Bender had a salary. We don't put it here. We actually put it over here in the distribution. So Leela got $53,000, Bender got $8,000. And in total, we had paid $61,000 in wages to Leela and Bender. So here, in order to get full marks, I know if you do that, you understand, but here I want you to tell me why it is in a deduction. And we would say it is not a partnership expense. That is all I need you to say in order for me to give you the full marks on that. We were also told that Leela had superannuation and Bender had some superannuation. Again, it is not dealt with here. It is dealt with over here. So we would put, that's their wages. Their super for Leela and Bender, again, is 0, and it is not a partnership expense. When we're looking at working out Leela and Bender's taxable income, so the income less the allowable deductions, we have to consider, would the superannuation be deductible at that point? So at this point in time, we end up with total expenses of $137,500. So our net partnership income is $97,700. Now, this figure here must be equal to the total that we distribute over here. These two must equal each other. If they don't, you've done something wrong, okay? And you need to be able to make sure that you're balancing at these points. Now we give you a format to follow, and sometimes there won't be any information in some of them, so just put 0. But if you follow the format that we've provided, it makes it easier for you to understand all the time. So you always start with the salary received, remembering that these three items are income that they have taken or paid to the partnership, which don't fall part of the income or expenses of the partnership. So interest on capital, we don't have any, so it's 0, 0, 0. Interest on drawings is 0, 0, 0. So at this point here, you would do yourself a total and say that I have distributed $61,000 of the $97,700. So I have $36,700 left. This is my balance. You then say, in what percentage do Leela and Bender share in the income? In this question here, they share 50-50. So even though their salaries and other things might not be 50-50, this is the point where we apply the partners' percentages. So in this case here, Leela will get $18,350 and Bender gets the other $18,350. We add up at this point to say that Leela has $71,350, Bender has $26,350. We go across and we would find that we had exactly $97,700. So A and B distribution is equal. So we know we've done the right thing. We then would go on to work out, oops, losing them again. And part C is to work out the taxable income or the tax payable. In this case, we just want taxable income for Leela and Bender. In other questions, you'll be asked to expand that further. You'll be asked to expand the tax on the taxable income. Now, remembering partners, if it's a business income, would be entitled to the small business tax offset, which you have to calculate. Remembering it's 8% of the tax on the business income, or it is limited to $1,000. Depending on their taxable income, they may also be entitled to low income tax offsets, the low medium income tax offset, and any franking credits that might apply. In this case, we know that Leela has a distribution of $71,350, which is assessable income. She also has a salary from an outside job, which Bender has actually. So Bender has $26,350 from the partnership. The salary from the job for Bender is $56,000. Now, important to remember here is that $56,000 belongs to Bender. He is an employee of somebody, so it doesn't form part of the income of the partnership, and Leela doesn't get a share of that. It's something outside of the partnership income. So at this point here, the assessable income is $71,350 for Leela and $82,350 for Bender. Was there any deductions? Because we always have assessable income minus allowable deductions, so less deductions. We know from here that they had superannuation. We didn't claim it as a business expense in the partnership because it's not allowed. So super for Leela was $12,000. And super for Bender was $450 paid by the partnership. It is an individual tax deduction for them. It's not the partnership's deduction, it is their deductions for superannuation. Leela would be okay because she's got no other employment income. Bender, we'd have to have a look and say, remembering that the limit that we can pay from both an employer source of income and our own allowable deductions for superannuation as an employee or a business owner, a sole trader, is $25,000. So in this case, we could say, well, 9.5% plus that $450, it would be totally less than $25,000. Therefore, we'll allow Bender the tax deduction that he paid personally. So Leela ends up with $59,350. And Bender ends up with $81,900. So I wanted just to show you this basic question so that you understood the format. A, always work out the income less the expenses of the partnership to get net partnership income or loss. A partnership is not a taxable entity. Everything the partnership has as this final figure is given to the partners to deal with in their own income tax return. Other things to take into account with partnerships. If you had dividends, so a partnership could invest in a company could pay dividends with franking credits. The same rules apply. Dividend is assessable income, franking credit is assessable income, and the franking credit would be offset down here under the partner's share of the distribution. So once you've worked out net income, net loss, distribute it according to the formula, the format we have given you there. Then you work down and deal with the individual taxpayers or the partners accordingly. Again, for them, it's assessable income less allowable deductions, tax on taxable income, Medicare left rebates. An important thing to note with partnerships is that they never ever have a capital gain. A capital gain is always dealt individually in the partner's individual tax returns, and in your books and in the iLecture we go into some details to why that is. Now if we made this a big question, it would still end up being exactly the same A, B, C steps, except we might have more income, we might have more deductions. These 4 steps here aren't going to change. You're still going to have these boxes that equal the net income. The tax on taxable income for the individuals might change as well. They might have other income, they might have capital gains, they might have other deductions and the rebates we have to apply. But just remember, A and B must always equal each other. B is distributed to the partners according to the distribution formula. So here 71,350 went down, here 26,350 went down as well. So I'll leave it with you there. The next question I'm going to deal with in a moment is in regards to another topic that is contained in this partnership topic. Thank you.